NPV rule, the gold standard of decision-making. John's keyboard business is thriving, but success has brought him to a difficult crossroads. He has saved enough capital to make one major expansion move, but he cannot do everything at once. He is faced with two competing opportunities, what finance experts call mutually exclusive projects. The first is Project Flash, a high-speed assembly line that is relatively cheap to install and will start generating massive cash immediately, paying for itself in just 18 months. The second is Project Steady, a more expensive, custom-built robotic facility. It will take much longer to pay off, but it is designed to last for a decade and produce a much higher volume of premium keyboards in the long run. John is naturally leaning toward Project Flash. He likes the idea of getting his money back quickly. This is the logic of the payback period rule, a simple rule of thumb used by over half of the corporations surveyed in the field. The payback rule asks one simple question: how many years must the company wait before the cumulative cash flows from the project equal the initial investment? For John, Project Flash looks like a no-brainer because of its short payback. However, as Brealey, Myers, and Marcus warn, the payback rule is a dangerous and unreliable guide. It has two massive flaws. It completely ignores any cash flows that happen after the payback date, and it fails to account for the time value of money. If Project Flash breaks down the day after it pays for itself, while Project Steady keeps printing money for another 8 years, the payback rule would never tell John the difference. Frustrated by the simplicity of the payback rule, John turns to another popular metric, the internal rate of return, or IRR. He calculates that Project Flash offers a 25% return, while Project Steady offers only 20%. Again, Project Flash seems to be the winner. The IRR is the discount rate that makes the net present value of a project exactly zero. It's an attractive number because it's easy to compare to the interest rates offered by banks. But even the IRR has pitfalls. It cannot properly rank mutually exclusive projects. A small project with a high percentage return might actually add less total wealth to John's company than a large project with a slightly lower percentage return. If John only looks at the percentage, he might choose to earn 50% on a $10 investment rather than 15% on a $1 million investment. He would be efficient, but he would be poor. To find the true answer, John must use the gold standard of corporate finance, the net present value, NPV rule. The NPV is the difference between a project's total value and its cost. To calculate it, John takes every single dollar the project is expected to earn in the future and discounts it back to today's value using his opportunity cost of capital. Then he subtracts the initial investment. If the result is a positive number, the project is creating wealth. If it is negative, the project is destroying it. Unlike the other rules, NPV is the only criterion that is always consistent with the primary goal of the corporation: maximizing shareholder wealth. When John accepts a project with a positive NPV of $100,000, he is essentially making his business $100,000 more valuable the moment he signs the contract. This is why approximately 75% of chief financial officers at large, sophisticated firms rely on NPV as their primary decision-making tool. It is the truth serum of finance because it accounts for the timing of cash flows, the risk of the project, and the total magnitude of the wealth being created. John sits down with the spreadsheets and runs the numbers for both projects one last time. He discovers that while Project Flash has a faster payback and a higher IRR, its total NPV is only $50,000 because it ends so quickly. Project Steady, despite its slow start and lower percentage return, has a massive NPV of $200,000 because of its long-term durability and scale. By choosing Project Steady, John is adding 4 times as much value to his company's future. He realizes that the quick and dirty rules were leading him toward a smaller future. The NPV rule forces John to look at the big picture. It teaches him that a manager's job isn't just to get the money back, but to deploy capital in a way that generates the maximum possible surplus over the cost of that capital. By using NPV, John ensures that he isn't just staying busy, but is actively building a more valuable empire. He understands that money has a cost and time has a price. With the gold standard in his hand, the fog of uncertainty clears. John decides to invest in the robotic facility, knowing that he has chosen the path that maximizes the long-term wealth of his business and its future shareholders. He has moved beyond the simple instincts of a shopkeeper and has begun to think like a master of corporate finance.